webinar. Really excited to see you all here. For those of you that don't know me, my name is Mike Supervici. I am the head of acceleration here at Desol Group. Desol Group is a company that's trying to modernize venture capital, and we're trying to do this across the entire ecosystem. We have an accelerator program called VC Lab, which has launched over 470 venture capital firms in the last 2 years. That's been very successful. We have another program called Venture Institute where we train associates and other type of staff members for the firms. And finally, which is what we're all here today, we have another program called the LP Institute where we help limited partners, hone their craft, especially when it comes to investing in new and emerging managers. What we have here today is a panel where we're going to be discussing, kind of best practices and so on and so on. If this is your first time joining us on one of these webinars, you can introduce yourself in the chat. There's a chat on the right-hand side where you can say hello and things like that. If there are any GPs on the call right now, do not put in your thesis or what you're working on. That's potentially a general solicitation risk. So I just wanted to make sure that you understand that. But you can certainly say hello and introduce yourself to the folks here and so on. If you have questions for myself, for the panel, there is a Q&A button at the bottom of your screen. So you can go ahead and put in a question in there for the panel, and I'm going to do my best to relay it over to the panel as well. So there's a Q&A button. You would simply select the Q&A, add your question in there, and we'd go ahead and send that over to the panel. We're not monitoring the chat at all right now for questions. So if you do have questions for us, let us know. We do want to make these panels and webinars very interactive, because the more info, the more we share together, the better we're all going to get, right? Including ourselves, including the panelists here. And so this has been typically our approach to a lot of these things. So please, let's make this interactive. Of course, I have a lot of questions as well for the panel, but we certainly want to do this more for you and from everybody to kind of learn from each other. Okay, so just something to think about as well. So before I get started and we introduce the panelists here, one quick thing I have to read here is that, classic kind of disclaimer language here. This is kind of standard for these sort of webinars. The content presented today is not directed at any investor or potential investors and does not constitute an offer to sell or a solicitation of an offer to buy any securities. All right, so now that we got that out of the way, let's get the show started. First, let's go through the panelists here and let's have everybody quickly introduce themselves. So Lance, maybe we can start with you. Do you mind maybe quickly introducing yourself?
No, absolutely. My pleasure. Great to be here. My name's Lance Cottrell. I'm a exited founder and active angel investor. I'm on the board of directors of the North Bay Angels and run our selection process there. And I also spent a lot of time working with founders as an advisor through the Founder Institute and through my own website, feeltheboot.com.
Awesome. And it's really good to be on a webinar with you again, Lance. It feels like it's been a long time since you and I have done one together. So it's great to see you here. Melissa?
Hey everyone, I'm Melissa Lee. So excited to be here, and I see a lot of people from different countries in the chat. This is super cool. I'm an investor with Offline Ventures. We're a venture fund based in San Francisco. Before Offline, I had experience with direct investments as well and evaluating early stage tech startups. And so having seen how venture funds operate from within and having been in direct investing myself, that's a really valuable perspective to now being on the other side of the table as an LP. And then before that, had a platform role at an early stage venture fund, thinking about value add post investment and how, that's now informed how I think about how emerging fund managers carve out an edge in their strategy and how they structure their firm and other strategic offerings. Excited to be here.
Super cool. And finally, Scott.
Yeah, hi everyone. Scott Tilton. I formerly was a co-founder and CEO of a sponsorship analytics company called Hookit. We successfully exited out of that in January of 2022. I quickly became an operating partner at Arrowroot Capital, where I'm kind of learning the ropes there. I sit on a couple of boards, And I'm now looking at various funds to get involved in as an LP. Excited to be here.
Super awesome. So maybe where we can start, everyone, love to just get your views, right? There's a lot of information right now with regards to kind of like, hey, how's like the kind of overall market for startups, for venture, for so on. There's lots of opinions. Some opinions are like, oh, the venture market is pulling back. Some opinions are like, hey, the market is doing really well. A lot of innovation and things like that. I'd love to go through everybody here on the panel and sort of just get your views kind of on kind of what the market outlook looks like right now. And I don't know, Melissa, maybe we can start with you since you kind of sit on both sides, right? Both as a venture investor and now as also an LP and kind of other funds. I'd love to get your views on kind of what the market outlook looks like right now for startups and for venture.
Yeah, absolutely. Thanks, Mike. I'm really excited. I mean, venture is back. We certainly had a rough couple of years, but I also do think that amazing founders are born in, down times. Having to be more disciplined around when to fundraise, for example, and how you're allocating your funding and how and when you choose to go out to fundraise and needing to be further along in tractions and sort of proving out milestones before you raise. That was certainly the case for the past couple of years. I think coming into 2024, we're seeing the funding boom come back somewhat, and that's a really exciting time. I do think, however, we're now at a somewhat different place to where we were in 2020, 2021. The first is that, coming out of the bubble burst of the last few years, we're seeing more acqui-hires and more fire sales. So, startups that kind of like backed themselves into a corner with highly inflated valuations. These founders are now, by and large, preferring to sell rather than drag it out. Meanwhile, all these tech giants have the war chests and the balance sheets to be able to take on these startups. And so I think we're going to see more acqui-hires this year. And then, the other thing that I'll say on the direct investing side is that we're seeing relatively fewer bridging rounds. And I think GPs in general are encouraging their portcos to be more resourceful with existing capital. And this is a really great thing to sort of promote diligent company building. And so broadly, I'm seeing more capital being put into more bets rather than doubling down on existing bets. And so I think this is a really great time for founders to be fundraising coming into 2024. I just think there's a little more diligence around being further along in your company building process, more milestones, more rigor around, what's the business model? Is this a viable business? Than perhaps in the past few years, but it's a really great time overall.
Scott, what are your views?
Yeah, I think, and like I said, I'm relatively new to the LP side of things and the venture side. Given I was an operator for 20 plus years, I was very familiar with the fundraising side of things. We had raised a fair amount of capital for Hookit, and I know how grueling and difficult and challenging that can be, and just getting beat up on term sheets and valuations and all of that. So I was excited to really kind of come to the other side and learn a lot more about the process and the evaluation of companies and things. And everything I've learned so far is it really feels like venture investing is a bit of a roller coaster. So last year, I think, or 2021 was kind of 15 plus year highs in terms of returns, and 22 and 23 were 10 plus year lows. So it's kind of all over the place right now. And when I look at Arrowroot and some of the other funds, it does seem like, to Melissa's point, things are coming back in a really big way. But VCs are being a lot more explicit about what they're investing in. So there's clearly a lot of attention around AI. There's still a lot of activity on the SaaS side of things, but it's really geared more towards the outliers that are having double and triple digit growth. Some of the kind of average and mediocre growers are having a much more difficult time to raise funds right now. And on the seed side, there's still a lot of interest in strong founders, strong teams, and really interesting products. So I think the biggest thing I've learned so far is that venture is not a short-term view. You have these ups and downs, and it's really about supporting entrepreneurs and innovation for the long haul. So these are definitely more 10, 15-year horizons.
Yeah, 100%. Couldn't agree more, especially pre-seed and seed, right? These are, like you said, 10 to 15 year horizons. And, they're generally going to skip a lot of these like kind of up and down market fluctuations. The bets you're making now, are going to probably, especially if they end up becoming successful, are probably going to have less impact because of that long-term horizon. Lance, you've been in this for a long time, right? Obviously, you've kind of seen this on the angel group side. You've seen this as a, as an investor as well, and funds as well. Like, super curious to see your views, also as founder too, right? So you've had kind of the whole gamut here. How do you
Yeah,
see
absolutely.
it today?
I think right now, and certainly with my group, and we've got a lot of people who both do direct investing as well as our LPs and funds, and we don't have a fund, so we're just looking at things individually. I feel like there's a lot of cash sitting on the sidelines right now. People are a little concerned about where things are going, but also they have real liquidity issues. So a lot of us, both with our individual investments and with some of the funds that we're in, there have been a number of companies in the funds that are successful. The fund's now hitting, 10 years plus into its lifespan, but they're not releasing cash because the companies are not where they could be. They've taken a hit in valuation in late rounds, that maybe they've even gone public, but the public markets aren't being very kind to them. And so many of us at that kind of pre-seed level, the more the retail investor space, don't have a lot of cash to deploy right now. And I think a lot of us are waiting for the IPO market and the stock market in general to come back a little bit more before we have the returns from the previous investments to start deploying again.
Fair enough, right? And that's a pretty normal point, kind of a point of view, and it makes a lot of sense that you kind of have that. And so the way you're sort of thinking about this, Lance, I just wanted to quickly double click on this, is that at some point there's going to be like liquidity coming from these funds, and it seems like a lot of folks, like, with these are like 10-year funds, but generally they're like more like 12-year funds, especially at the pre-seed level, just because it takes so much longer for companies to go public now. Once there's more liquidity in some of the stuff you've done, maybe like 5 or 6 or 7 years ago, that's when you think you're going to become a little bit more active, or are the folks in your
Exactly
angel
right.
group feeling it this way as well?
Yeah, I think there's a lot of frustration within the people that I know that they're seeing the opportunities. You know, as Melissa was saying, a lot of these big wins happen in downturns as you're coming out of downturns. The companies that were founded then, who are now starting to grow into the new cycle in the market, those are some of your most profitable opportunities. And I see a lot of people who want to be jumping on those opportunities, but don't have the dry powder to do it right now, at least within the circles that I see. I think some of the funds where they have commitments, right? They have capital calls that they can make, that they put the fund together maybe during the high times. They're going to be able to take a lot of advantage of this because they already have that cash at hand. Whereas if you're pulling it out of your own pocket, it's a lot more challenging.
I mean, speaking of opportunities, you mentioned sort of like that we're kind of at a good inflection point, lower valuations and things like that. Curious, and this is for the panel as well, like, what are some of the opportunities that you're particularly excited about, especially in 2024, as we sit here right now, almost, a quarter through? I'd love to get everyone's views on this. Maybe Scott, we can start with you on this one.
Yeah, I think this year is, I keep reiterating this. This is very much a learning year for me. My kind of strategic goal is I want to get involved in one fund this year, and then potentially another 1 or 2 the following year. And the first fund that I want to get involved in is something that is familiar to me. So I have a sports, entertainment, and tech background. I'd like to stay in that space with my first fund, where I know I can add value and be a good, strong contributor to the fund and the portfolio companies that are involved. So that's kind of where my initial focus is. And then down the road, I'd like to look at funds in other markets. I spent 20 years working in the same industry, so it's once you get out and you pick your head up and look around, there's a lot of really interesting things going on. So, I'm definitely probably more on the conservative side to really understand the markets and the funds and where their focus is and what they're going to invest in. And that's going to be kind of my 2-year plan, is to branch out of what I know after this year. So, but yeah, so I want to start in sports and entertainment tech and really kind of dig my heels in this year and that, and then expand from there.
Yeah, it makes a lot of sense. And, with obviously investing in funds, you get a lot of exposure to a lot of different things, which is a pretty cool and interesting way to go about it. Melissa, what are you particularly excited about right now in 2024?
Yeah, I am really excited by how family offices are coming more into the venture space. I'm tracking a lot of sort of the intergenerational wealth transfer and the idea of succession for large multi-generational family businesses that are now setting up venture funds as an attempt to keep it within the company. Obviously, we're seeing sort of America's biggest intergenerational wealth transfer happen right now, and a lot of these family offices bring a super strategic lens to venture. We have family offices in media and entertainment, for example, that can be a huge value add to the founders that they back. And so sort of getting acquainted in that space is really interesting. And I also think, 2024, like especially in the consumer side where I do a lot of direct investing personally, it's really interesting, like the way that now, VCs are thinking about distribution is completely different. Kind of what Mark Andreessen was saying in that, the next $1 billion D2C brand is going to have to be celebrity led. Just because that's the only way distribution really makes sense from a dollars perspective now for a lot of consumer brands. And so I think there's increasingly opportunities for institutional venture funds to play in the celebrity space, kind of what Scott was talking about, or family offices through adjacent to the celebrity world is really interesting. But more generally as an LP, I've seen the venture asset class become more and more mature. And so, I think in the past couple of years, we've certainly seen a shakeout of funds that weren't performing so well. And we've seen LP dollars get increasingly selective about the venture asset class compared to other asset classes. But I think there's an opportunity here for new GPs to come out with like a real edge. And so I think we're going to see more and more vertical specific GPs who, do one thing, do it really, really well, as opposed to generalists. And I think there is a place for deep expertise in the new GPs coming out this year, which I'm excited about too.
Yeah, we're seeing the same exact trend. I mean, when you sort of look at most new GPs that are getting started right now, certainly through the VC Lab Accelerator, very, very specialized. They have like this really interesting edge that you're talking about, and they have a much higher chance of overperforming just because their value add starts to match, right? Kind of like what the founders, and they're getting into deals that you just wouldn't think like, how does this person even get into this deal? So it's pretty cool. It's pretty cool to see. Lance, I'd love to get your views on this too. Obviously, just where we are in the market cycle, that alone is obviously a great opportunity just because valuations are lower and, founders, it's kind of shaked out, and like a lot of the founders that are building companies right now are like building it the right way and stuff like that. But I'd love to get any other insights like on kind of what opportunities you see in this year with regards to VC.
I'm going to make a completely uncontroversial statement and say that I'm really excited about LLMs and AI, right? I mean, obviously it is coming out and disrupting everything. The impact is going to be gigantic, fully on par with previous major revolutionary technologies that have come in. I see so many companies coming out saying, "Oh, we're using AI," and I feel like that's already gone. That's now table stakes. It would be like in 2015 going, "Our company has a website." Well, I mean, of course you do. If you don't have a website, what are you doing here? But at the same time, from an LP perspective, looking at these funds, it is a fraught moment because I've been through a bunch of these boom bust cycles before. And when you have these revolutionary moments, everyone is dogpiling into the sector. And so there's a gargantuan amount of mediocre companies, Me Too followers, people who were just slapping some AI on the idea that they had from 2 years ago and trying to pretend like it's new and shiny. So when I'm looking at LPs in this space, and there's a lot of new LPs popping up saying we're going to go after AI, is how are they looking at differentiating that and really, because it makes the portfolio model more difficult because you're expecting some particular hit rate. But if you suddenly added 10x as many companies, but not 10x as many unicorns, the filter needs to be much stronger to find those good ones. And the people that interest me are the ones who are going after what I think of as second wave or second order AI effects. So it's not, oh, we're going to use an LLM in our business. Of course you are. But rather the companies that have access to some exclusive training set or data source, or are able to leverage something that is more proprietary with the AI piece to be able to generate some substantial value, but also a defensible position. Right, putting a wrapper around ChatGPT is not a defensible model because it's trivially easy to do. And I also like the people who are betting on the selling shovels to miners kind of companies. Right? We know that there's a huge amount going to happen in this area. companies that win, no matter which specific company wins, are also, I think, a very exciting space right now.
And that's so true. Just in this last cohort, right? A VC Lab 14, we're on the 14th cohort. I think we have 20 plus of funds, possibly more, maybe 25 funds that are focused on AI. And so it kind of brings me back to like my next question. And Lance, maybe we can just start with you on this one. Like diligence, like how do you diligence that, right? Like how do you diligence if, Melissa, you mentioned that, the edge, right? That the manager has to have an edge or whatever. Like how do you sort of diligence for that? And what are some of the key insights that you look for to make a go, no go decision? Lance, maybe we could start with you, then we can go to Melissa and maybe Scott to wrap it up.
Yeah, I mean, I think I like to see some operational experience in the GPs that I'm talking to, right? I'd like to see them have been on the inside of this startup world, especially because it's where I'm focused in sort of that pre-seed level where a lot of your classic financial analyses aren't going to be that significant. So you want to be able to understand, is this company doing something exciting? Do they have a real specific insight into the kind of business that they're building? And so I'm trying to get that insight from the GP that they're thinking about it that way. And also looking at the founders in terms of the way they approach business. Right? It is super important for the team at that early stage because we know that most startups are going to undergo a pivot, usually a large pivot. So the details of the model that they're presenting to the GP aren't all that important, right? They probably won't be doing the thing that they pitched when they eventually become successful. So what really matters is looking at how they think about it. And this is certainly the way I think about it as an angel is, for example, when I look at a company's financials, I know the numbers are all a joke. They're completely wrong. But they tell me a lot about how that person thinks about their business. What did they see as the KPIs? How did they look at the way this is going to grow? What things have they validated? And I want to make sure that the GPs I'm backing are taking that kind of perspective when they're looking at pre-seeds, especially in these super frothy spaces where people can be obsessed with and excited with the technology and the revolution that's taking place and the tech stack that they're using, but often are not as interested in and thinking about the model of the business that they're creating.
Melissa, what are your thoughts?
Yeah, I couldn't agree more with what Lance said. I obviously look for prior track record as an angel or as an operator. I think it's absolutely okay if GPs don't have a traditional background, rising through the ranks in institutional venture, but I do consider an angel track record and previous returns to be important. Ideally, if you're an operator, you have differentiated network access and you can uniquely source from different startup mafias. And that's kind of where your alpha comes from, because when I think about GPs, like alpha really only comes in the form of one, unparalleled information access, like being able to see the best deals, being able to see them first, and having the advantage of being able to invest at a great price. And second, sort of brand, like the ability to leverage your personal network to be able to actually win those deals, not just spot them. And then third for me would kind of be the ability to sort of pick and understand what's real tech versus what's hype. I do love GPs that have a very, very clear thesis and can articulate it, and they're just really excellent, first principles thinkers, and they're highly differentiated in what they're thinking about. Sometimes I've had GPs say that they're only doing XYZ sectors, but they're kind of not able to articulate why that's the case or why they're likely to find the highest returns in, XYZ sectors that they're actually focused on. On the question of being able to win deals, can they articulate what their edge is to founders and how they support founders differently? Increasingly in venture, we're seeing really, really hot rounds that fill up within the week. And so sort of what is this GP's reputation within their circles? Do they have the right sales skills? Are they known for a skill set where they can really help startups raise their next round of funding or fill out the rest of a founder's round or whatever other kinds of value add that a GP is proposing? And then lastly, I'm sort of thinking about whether this GP has a skill set across the life cycle of the investment. So, sourcing and having the network and being able to win a deal is part of it, but also, knowing how to do the due diligence and knowing how to structure deals and knowing how to negotiate for the right terms, because ownership is a really important make or break thing in early stage venture. And I think a lot of people overlook that a little bit. And so that was a lot, but that's sort of a download of like how I think about GPs.
That's wonderful. I've learned a ton from just what you said. You know, one thing that we would do, at least on our end, is also, you know, are they doing what they said they're gonna do? Right. So for example, if a GP says that I'm a pre-seed investor and your first deal is like a series A, right, like that's weird, right? Like that kind of stuff. But that kind of stuff happens all the time, right? Like a lot of people sort of sell the dream a lot of times when they're kind of going after these funds, right? And then like they end up like doing something completely off, and that's not great, right? So something to sort of think about as well. Scott, what are your views on this? What are some of the things you look for? I know you're sort of just getting started, but
Yeah,
like
I think
kind of
just back to your original question on the AI side of things. Yeah, I think AI is such a hot sector right now. It can also be extremely overwhelming. I think you mentioned you have 30 new funds starting up that are focused on AI. But yeah, what it seems to me is that you need to look at companies that not only have really ambitious aspirations for what the technology can do, it also needs to demonstrate real world applications in terms of how it's going to add value. So how they can solve real problems, and then also have proven or like revenue streams that they can tie to it. Because AI, it seems like it's been more of a buzzword over the past few years, but now there's some really strong applications that are coming out, such as like automation, data analysis, personalized experiences. So how is the AI being used, and is there a clear revenue stream that's going to be tied to it that can be sustainable and scalable? So I think those would be some of the things I would look at if I were evaluating an AI fund or an AI company. In terms of looking at the funds and the managing partners and things, track record is probably everything. A lot of the funds that we're looking at though are earlier stage, so they might be new funds, and it's harder to see the track record. Because they're not proven yet. So I've spent a lot of time kind of digging into what they were doing previously and other successes that they've had, and if they've made any investments, even if it's only a couple, really doing pretty strong due diligence on those companies and why did they make the investments, how are they performing, do I think the business model is sound? Because with some of these newer funds, you're just not going to have the track record and background there to be able to properly evaluate. So it's all a learning experience right now, and it's been very intriguing.
Everyone, I noticed that there's some questions starting to come into the Q&A. This is great. There's a lot of people on this call, like 146. There's quite a lot of questions coming in. So put your questions into the Q&A. Okay, there's a Q&A button at the bottom of your screen. I'm about to start asking the panel your questions and upvote, right? Upvote those questions, okay? So, let's go ahead and get your questions in. So there's a question here from Krill, and it's basic, I'm paraphrasing Krill here, but it's like related to inflation, right? And it's like, how does inflation, the Fed, whether it's going to lower or increase rates, how does that sort of affect, your willingness to deploy capital into funds? And this is for anyone on the panel.
I'll jump in. Very little, other than sort of just what is my personal ability to write checks at any given moment, especially when we're looking at relatively early companies, right? We're not talking about a fund that's investing in the D round of some, advanced unicorn, but sort of pre-seed to A or B. The time frames are so long compared with these economic cycles, and I think Mike was mentioning that earlier, that it just doesn't come into my calculation. I'm looking at the fundamentals, the growth that we're looking at achieving with these companies is huge compared to even pretty extreme inflation, and I'd expect that inflation just to raise all the boats anyway, since it's based on fundamental underlying value, not nominative dollars.
Yeah, and happy to jump in here. I mean, inflation is something that I personally don't think as much about. I sort of frame VC as an asset class as relatively softer, and that there are a lot of reasons that you might want to get involved, right? It's like a way that you get to interact with some of the smartest people around who are creating alpha through differentiated philosophies about tech. And I think, you see in the VC asset class, like so many LPs are very, very involved in venture in some capacity as advisors. And that's, more true of VC than it is for other asset classes like PE and hedge funds. And so I think, like, interest rates aside, I think it's a really interesting opportunity just to learn, collaborate closely with fund managers and to get involved in some capacity in like investment due diligence or portfolio support as an LP or sort of like as a network play. And so it's not always as quantitative. I think there's a lot of soft reasons for why you might be interested in VC as an asset class from the LP perspective.
There's a question here from Ali, and to paraphrase also Ali's question, like for funds that are targeting, let's call it legacy industries or industries that are kind of laggards in adoption. So that they're mentioning here construction tech, but there's a whole bunch of other ones like that. What would you look for in managers that are sort of like targeting these types of industries? And obviously very specialized and all, but what would you look for and what are some of the key signals that is like, oh, this is a good idea. This is someone that I may want to look for, because obviously the industry itself that they're going after may not have the type of growth that say like AI has right now, but there's obviously opportunities to sort of modernize it as well. So just curious, because there's quite a lot of people going after legacy industries these days.
Yeah, I can jump in on that. I think some of these markets are primed for disruption. So if even though they're kind of older school, I would say that what is the fund strategy on how to disrupt that market and add value and create growth rates that weren't there previously. Like construction as an example, which I think was in the question. It's an old school model, and there's a lot of inefficiency in it, and just in the terms of the way they manage like builds and real estate and everything else. I think there's a lot of opportunity there to go in and really, to your point, modernize it and create a lot of value add that will create new revenue streams down the road. So I do think some of these markets that may not be as sexy as AI have a lot of potential and a lot of growth opportunity.
Yeah, I would agree with that. I mean, I think some stat like 98% of America runs on small businesses. And I think, sometimes investing in high tech, thinking about AI and crypto has GP sort of somewhat removed from the realities that a lot of, S&B owners or folks that are playing in legacy spaces are, the problems that they're tackling on a day-to-day basis. And so I think, Scott's absolutely right. These spaces are ripe for disruption. I would say though, like if a GP is thinking about specializing in the legacy sector, I would want that GP to have knowledge of that sector in and out. Like, what are the regulations and laws affecting the space and new players coming in? If adoption of tech is lagging, is it because there are structural problems in that industry? Is it because the incumbents have always just choked out, the growth of challenger startups? Like, is it that the sales cycle is just immensely difficult? Is it that key decision makers in large legacy players just like are averse to the tech? And so I want a GP who understands that industry and the incentives inside and out before they can be well positioned to then invest in tech startups supporting that industry.
I would double down on that. I think that it's going to be track record. My angel group has gotten a lot of these sort of legacy tech kind of startups approaching us, and they're super hard to diligence because so much of the impediments that they have are not so much, can you build this tech, or will this thing explode, but can you get this dinosaur industry to adopt it? Will they pick these things up? You don't have this huge population of early adopters like you have in the tech industry, where lots of people will pick up your new SaaS and start using it quick. The construction industry and a lot of these legacy industries are very, very lagging. Everyone in them almost is a late adopter. And so I'd be looking for people who really have exactly that insight that Melissa and Scott were talking about, to be able to see through that cloud and understand which people will have a good chance to win.
Yeah, that's a really good point, Lance. I think the adoption is key because these industries that are legacy, it's changing behavior is the hardest part of how do you get them, if you're going to revolutionize the industry, how do you get the market to really adopt it and transform with it? So it's, again, it goes back to the applications of like what value add are you bringing to the space to modernize it, but then how quickly will the market kind of follow suit and adopt it? And that's really where things start to unlock a bit.
Speaking of track record, there's a couple questions right now with regards to track record. One is basically like, you know, if I'm an operator, I have most of my experience in corporate and things like that. How do I sort of like quantify, or how do I show my track record to be interesting to LPs? And then another one is, you know, what are some of the metrics that maybe you look for, especially for folks that maybe are going on to like fund two, you know, as part of that. So I'd love to kind of get your views on sort of how you think about track record. I mean, everybody here has kind of mentioned like, look, when people are like emerging, the track record is a little bit more nebulous, right? You're sort of going after what they've done in the past, but they maybe haven't like run a firm before. So it's not like, you know, they're Sequoia or whatever, they've done this multiple times kind of thing. So I'd just love to get your views on track record here for everybody on the panel.
Yeah, happy to jump in on, you know, what does it mean to work in corporate and then shift over to the GP side. I would say I think there are softer ways to prove out a track record that, you know, doesn't necessarily have to come from having worked in institutional venture before. I think if you have any amount of, you know, interest in angel investing, you know, even supporting friends and families businesses, and sort of developing a track record that way, that can be really compelling. You know, you might have worked for a high growth corporate, you know, where you might have scaled a department from 100 people to 1,000 people, and that's part of a really valuable operator track record. Perhaps that corporate had a valuable sort of innovation culture where a lot of people, you know, a lot of alumni then left that corporate and spun out into their own companies, and then you invested in those companies. I think there are also softer ways to angel invest without necessarily having to put capital to work, like personal capital. You know, there are ways that you can leverage the expertise and the skills that you learned during your time in corporate, and you can support, you know, early stage startups with fundraising and IR if that was what you were focused on. Maybe you're a BD and go-to-market expert and you take, you know, 1 to 1.5% equity because of how indispensable that knowledge is. And so I would say there's a lot of softer ways to create a track record, not limited to personally angel investing, advising, sort of crafting a narrative about how you're a superstar operator, but also, you know, what is your soft network or value add through your connections gained from working in corporate.
Yeah, with the fund that I'm looking at right now, that doesn't have a strong track record because they're just, where I dug in was looking at the previous firms that they were involved in and what their successes at those firms were. Because this fund is 3 managers that have come together, all from different funds prior. So I really dug into how many investments did each of these folks make at those previous funds, how were those funds successful, how many exits did they have. So they're able to kind of demonstrate a track record from their previous life. And you're just hoping that they're going to be able to carry that on into this new fund. And they did make 2 investments already, so in the past 6 months. So I dug into those 2 companies and looked at, you know, what was the valuation when they invested. One had actually raised, or they're in the process of raising another round. And I really just looked at the, you know, the sales and the revenue and the profitability of the companies that they've already invested in. Like, are they strong businesses? Are they growing? So it's only been 2 investments. Are they making good decisions now, where they're trying to make 36 more investments over the next 4 years? So you really have to just look at any nugget that you can to see, like, are they making good decisions and have they done well in the past somewhere else?
I've seen a lot of people starting funds that have come out of running syndicates, and that seems to be an easier way in, because with a fund, you're fundamentally saying, you need to trust me to pick all the companies. And so there, that kind of track record and history is more important. Whereas with a syndicate, you're effectively selling that company and you're saying, I've got access to this, I've done some analysis on it, but the investors are making their own decision on a case-by-case basis. So I think people are more willing to trust maybe a newer manager in a syndicate. They can then develop a track record through that syndicate, through getting a bunch of hits and interesting access to deals, and pivot that into a fund and leverage that as some track record. It takes a few years, but I think it softens that curve of trying to develop that history and proof point.
And what metrics do you sort of look for, especially since, you know, most of these funds obviously are not going to have like classic DPI, so they're not going to have like returns. And if they have returns, they're generally going to be bad returns, right? Because like if a return comes in like in year 3 or something, that's generally not the greatest company, right? You kind of the best companies, you know, are you going to take a, you know, a long time to get to that point? So what are some metrics that everybody sort of looks for within their track record?
You know, at first fund, second fund, I'm really am trying to look at the portfolio that they've put together and what kind of deals have they gotten into, what opportunities are represented in there. Do I believe that they've got, you know, unicorn potential in there? Does it feel like those are the sort of companies that I might want to pick? Because I am looking for people whose decision making reflects the kind of decision making that I might make in their shoes. Because if there isn't track record, you know, we're looking for some proxy.
There's a
It's
really,
tough. These newer funds.
Go Scott. Sorry.
Yeah, there really aren't many metrics to look at yet. So ideally, what you would want to look at is how many total investments have they made? You know, how many exits have they had? And in a lot of cases, that isn't there yet. So a lot of what I'm looking at now, even with this one fund, just I'll keep using it as an example of the 2 investments that they made. Are they sound businesses? Do they have good business models? Do they have strong teams? Who are the co-investors that went in with them? So are they making investments with other good investors that also believe in the business? So there's things like that. I think to Lance's point, yeah, there are more proxies right now. There's not hard metrics when you're looking at a new fund, because the metrics just aren't there yet.
Totally. And I would agree with everything that Scott and Len said. The only other thing I would add is like, you know, looking at those early portfolio companies, how has this GP thought about ownership and price? And I think having discipline with that is really important. It's sort of, you know, to Mike's point earlier, if a GP has sold that fund to me as being a pre-seed specialist, but they're then investing at sort of 30 million post, that then makes me think that perhaps they're investing off hype, or they're investing based off what buzzy co-investors are also in the round, and then they're investing based off FOMO as opposed to like sticking to their guns. And then I also think, you know, pace of deployment is interesting. You know, if a fund manager says, I'm going to deploy X amount of capital over 2 years, and then they blaze through it in like 6 to 9 months, that is maybe a sign that they're not being diligent enough with how they're evaluating companies and sort of pacing themselves a little bit. And then to Scott's point, I think, you know, co-investors, I'm a little mixed on. I think it's a helpful signal. You know, I typically think that the tier 1 blue chip firms do a great job of decision making. And so it's balancing that, like, you know, has this GP invested in companies that have also been backed by really great co-investors? It's balancing that with the fact, you know, with whether this GP has also done the work of like actually diligencing the company and not investing off hype. And then sometimes you get to 12 to 18 months in, and if you see that any of their portfolio companies have gone on to raise subsequent rounds of funding at, you know, a higher valuation, that can often be a positive sign as well. Just the fact that, like, you know, those early bets have effectively hit the right metrics, have enough traction to be able to flip over the next card, which is the next round of funding.
There's a question from Evan here, and it's kind of double clicking a little bit on kind of what you mentioned, Melissa, with regards to sort of like the specialized funds. How, you know, what are some of the pros and cons, or how do you think about, like, go to a little bit higher level, specialist versus generalist? You know, there's obviously quite a lot of debate about that in the industry, but I'd love to kind of get your views on kind of what are some of the benefits of folks that are specialized, what are some of the benefits of not specialized, that kind of thing, and kind of just your general views on this as LPs.
Yeah, absolutely. Oh, sorry.
Go.
Go ahead. No, I'm letting the thoughts percolate. You go ahead.
I tend to think that my gut is it ties to stage. That is, the earlier stage the company is, the more I'm looking for a specialist. someone who really understands the specifics of that market. Whereas if I think you're coming in at, say, a C round, it's a well-established company, they already have product market fit. Now more of the kind of classic fundamentals and financial analyses are going to be a driver of whether or not that company is successful. And the generalists probably have an advantage at that kind of later stage.
Yeah, I would say that with specialists, it can be really great if you know your sector very well. But if you've kind of chosen to specialize in an industry relatively arbitrarily, or because you thought it was the right thing to do at the time, or it was the most hyped up industry, you risk backing yourself into a corner when that industry doesn't perform so well. And if you are an investor that invests based off hype, that could leave you in a really uncomfortable position. And so I'm really bullish on specialist investors that have done the deep work of thinking about, like, what are they uniquely qualified to do really well? Where do they have deep network access? What are they bullish on, regardless of how, regardless of what signals are coming from the market? I think those are the specialist fund managers that tend to do really well, the ones that have been incredibly thoughtful about what to invest in and why. Whereas, like, I'll also sort of use an example coming out of like 2021, 2022, we saw a lot of like crypto specific funds, shut down for a little bit, rebrand and come back as AI only funds. And so those are the specialist funds that I don't love. And so it's like having the diligence and the thoughtfulness to get sort of to get right what your specialist sector is from the start, I think is a helpful way to think about it.
Yeah, I think the only thing I would add is, I would tend to lead more towards the specialist side, just because I like the fact that people know a lot about a market and they know who the players are, they know who the strategics are, the buyers are, and they could add a lot of value when they know the space really well. So just intuitively, that's kind of where my focus is I want to work with people that really understand the markets that the companies that they're investing in operate in, because then they can add a lot of value.
Yeah, as an LP, one of the things I found that I gravitate towards in funds is people who are strong experts in areas that I think have a huge amount of potential, but which I personally don't know much about. So, for example, maybe it's a developing area, so Latin America or Asia or North Africa, areas like that where there's a lot of companies coming out. These people are deep expert there. They understand that market. They understand the economics of that space, of where the opportunities are, because I feel like there's a huge amount of opportunity in those areas, tons of upside, lots of unexploited niches, and I am profoundly stupid about it. And so people who are really deep experts in that are pretty appealing to me.
Yeah, I can agree with that more. To Lance's point, it's like, find an industry where information asymmetries will benefit you. There are some industries where having the first look or being the first to know about a deal, or having scientific knowledge is where your alpha comes from. There are other industries that are probably, so well covered in the media or just so well understood by a large group of people that the alpha really isn't there. And so that would be something I'd keep in mind as well.
There's a question here from Anthony, and it's more or less around the cons. Like, how do you find managers to invest in and diligence? Like, how do people kind of like access you, or how do you meet with these folks? Kind of, can you give some insights maybe for the new LPs that are getting started? Kind of, how do they sort of build in their pipeline? And for some of the folks that are on this call that are GPs, kind of what's some of the best practices for kind of reaching out and trying to get to know you?
I'm going to sound like a total shill, but I've got to say, joining the LP Institute increased the amount of reach I had by a couple of orders of magnitude. Getting access to a lot of funds was one of the challenges I had as an LP. A lot of funds reached out to me to take a look at their fund, and in many ways, I think that's not a great sign, because it seems to me that the most successful funds tend to be oversubscribed with people who know what they're doing. So going out, doing research, talking to other investors has been an effective way. Being in groups that do these kind of investments. So you've got more people sourcing can be effective, but it's something I found very challenging.
Yeah, I agree. The LP Institute has absolutely opened up the network of potential managers to get involved in and to meet with. And, I've already talked to a handful, and some of which are a fit, some of which are not. A lot of it's driven by check size and kind of focus and things. But outside of that, it's, really networking and talking to other investors. And there are groups, to Lance's point, which I haven't joined any of those, but through my own investor network from my previous company, I've been able to kind of find some new and interesting funds to talk to. But yeah, I mean, once you're in it though, it can get pretty overwhelming pretty quick because there's a lot of funds out there. And the VC Lab, what did you launch? Like 400 plus new funds?
Yeah, 470.
So there's no shortage of funds to talk to and get involved in. And venture is really hot right now. Like it has bounced back from 2021 or 22 and 3. But it's just taking time and finding the niche that you want to focus on and then doing the research.
Yeah, and I would double click on all of that. I mean, I think GPs that are fundraising have to be even more savvy with networking and relationship building than founders in some senses. Obviously, founders, warm intros can be really helpful, but as a founder, like the occasional cold email works great. Obviously, on the LP side, if you're a GP, like general solicitation laws, there's really no cold outreach, and so almost all of this activity is intro driven. It's friends of friends, and so I just say get out there and try and make friends, not just with other founders, but with GPs, and GPs will introduce you to LPs. Having a really diverse group of friends in tech, I think, is often the key to unlocking network.
And one of the kind of closing questions that we always like to ask in these webinars is, just knowing what you know now, what advice would you give yourself if you were just starting out as an LP? And I know for you, Scott, you are just starting out as an LP, so feel free to kind of interpret that question however you want. But in general, I'd love to kind of get everyone's sort of views on this, because we do have quite a lot of LPs that are starting to kind of get started now. And I think it'd be really great if they can sort of learn from your lessons and your experience. I don't know, Scott, maybe we start with you on this one.
Yeah, so I'm about 6 months into it, and I already feel smarter than I did when I started. So I'd say, yeah, the LP Institute was really helpful for learning the process for how to evaluate funds, how to do the diligence, everything from reference checks to doing your own research on the funds and the managers and the companies that they're investing in. There's a lot of stuff you can do to really kind of dive into these funds. So the process is really important to get clear on that. The piece that I'm kind of focused on right now is really understanding the metrics. And when you start seeing numbers and track records, it's like, is this good or not? And that's the part that I'm kind of focused on right now. And just getting a much better sense of like how to properly evaluate the funds when you have the diligence down, is to understand like, the likelihood of success is what you're trying to gauge. And so in that metrics phase right now, and it's and still learning new stuff every day.
Melissa?
Yeah, I would kind of give LPs 3 pieces of advice. I think the first would be to understand direct investing really well and get on the other side of the table. When you're diligencing GPs, it's often you're looking at the memos that they're writing. You're needing to speak their language, and you're needing to understand their investment philosophy. And so it's a really great thing to get on board that and sort of, you're understanding how the macro market is shifting and what the tech trends are. And so you just have to be fluent in thinking from the GP perspective. I think the second piece of feedback is just get really clear on your objectives. LPs will back GPs for a whole host of different reasons. And your objective is then going to inform, the things that you focused most on when you're diligencing, what you're indexing on, what your tolerance for risk is, and what your return expectations are. And so figuring out why is it that you want to be an LP? And then the third would be enjoy the journey and have lots of fun. I think uniquely, investing in GPs is very, very relationship driven. You know, you're often having multiple conversations over months and months. And so the time to make a decision is probably a lot longer than it is if you're speaking to founders in the direct investment side of things. And it's really great. Like, you get to understand this GP as a potential collaborator. You get to assess their vibe. Like, do you respect this person, their worldview? Do you think that you would enjoy spending lots of time with them as a collaborator in the future? And so it's like, you know, as you're trying to figure out how does this person think, you become really great friends with them. And I think that's a really wonderful process.
Lance?
I think I wish I had done a much more structured approach to the first fund investments that I made. Before I started angel investing, I made a rule for myself. I was not going to write a check for a year, and I was going to see as many opportunities as I possibly could. And that was hugely effective. And already with LP Institute and talking to more funds, I'm seeing the same effect there. That is, I saw interesting funds, I saw interesting managers, I was enticed and I jumped, but I hadn't level set yet. And I didn't have enough data points of funds and managers that I'd talked to really be able to differentiate them. And almost all of these people talk a good game. They've got stories about why they're the right person and why they've got the best strategy. But it's only when you're talking to a lot of them that you begin to get a sense and an intuition for which of these stories really has some substance behind it and which of these are just sort of fluff and, you know, everyone's saying the same thing about the deal flow that they have access to, but they can't really prove that out. So I wish I had done more of a talk to a lot of them, maybe set up some ghost portfolios, think about, take a look at how those decisions might have played out, and also get involved with a group of other investors so that you're able to leverage the experience of people who've been in that before and listen to the kind of questions they ask when they're diligencing, because there's nothing like having someone who really knows their stuff and being able to sit in and hear the kind of questions and the kind of perspective that they take on that to get you up to speed in making smart decisions.
Amazing, everyone. Thank you so much for doing this with us. I know I learned a ton just from having this conversation with you all. Hopefully everybody in the audience also learned a lot from this. And, you know, I just wanted to just give a big thank you to the panelists here. One of the cool things about venture is that venture is a very positive style of investing. You know, it's a deeply optimistic view of the future. And so, you know, participating in these funds is a way to sort of kind of try to help see the future that you want to see. And it's really great to sort of kind of see that just from kind of some of these conversations we've had here with you, Melissa, with Lance, with Scott. So everyone, thank you all so much for doing this. We do these events pretty much on a weekly basis. So subscribe to our events and tune in. Thank you, everybody. Really appreciate your time. Bye.
Thanks, everyone.
Thanks, everyone.
Ciao.